This is Alex Carter Reports, and if you have been watching the silver market closely, you just saw one of the most aggressive and carefully planned price crashes in modern precious metals, history unfold right in front of your eyes. In just 2 hours, silver dropped hard, falling nearly 22%, crashing from $90 down to $73 overnight on the Shanghai Futures Exchange, shocking traders across the world. While that drop looked brutal, the price picture tells a deeper story when you compare regions, because Western spot silver is sitting near $75, Western futures are near 76, Shanghai spot is around 86, and Shanghai futures are still holding near 90. That means even after all that chaos, China is still paying roughly a $10 premium for silver, which did not disappear even during the worst of the sell-off. Gold, at the same time, is trading at $48.21, adding another layer to what is happening across the metals market. If you are truly learning from this channel and getting real value from the work done here at Alex Carter Reports, make sure you are subscribed and have notifications turned on so you do not miss critical updates. After the recent video breaking down planned bank manipulation, many of you reached out saying you were unsubscribed automatically or that notifications suddenly stopped showing up. That kind of thing tends to happen when uncomfortable truths are exposed, but it does not stop this channel from continuing the work. The mission here remains simple and firm, which is to bring verified information, clear data, and honest analysis from all sides, whether the story points to manipulation or long-term accumulation. There will be no hype, no fear-driven panic, no greed-based promises, and no nonsense narratives meant to distract from the facts. What happened overnight was not normal market movement, and it was not random selling pressure either, because this was a coordinated financial battle. In previous coverage, Alex Carter Reports clearly explained that silver never closed above $90 on a daily basis, and that zone between 87 and 90 was marked as heavy resistance. That resistance was not a guess, not hindsight, and not opinion, because it was tracked, tested, and rejected multiple times in real market conditions. Each time silver pushed into that zone, the daily candles closed below it, showing sellers were stacking pressure and refusing to allow a breakout. The community following Alex Carter Reports was aware of this risk well before the crash, because the technical signals and broader fundamentals were monitored together. This channel does not gamble on emotions or chase breakouts blindly, but instead plans based on verified data, structural levels, and physical market signals. Meanwhile, copycat channels and mainstream voices are already preparing dramatic stories to explain the move after it happened, blaming banks, crashes, or mysterious forces. The difference is that Alex Carter Reports shared the real-time information while events were unfolding, not after the damage was done. If you are not following Alex Carter Reports on X, as well as YouTube, you are missing fast updates that happen before headlines catch up. The handle is the same on both platforms, and that consistency is how you know you're getting information straight from the source. So the real question now becomes what actually triggered this violent 22% drop from 90 down to 73 in such a short window of time. To understand that, we need to walk through the sequence of events step by step, because this is where the story becomes truly eye-opening. Earlier in the week, nearly 3 million ounces of physical silver were removed from COMEX vaults in a single day, which is not a typo or exaggeration. Almost 2 million ounces were withdrawn from Asahi alone, signaling strong physical demand pulling metal out of the system. Over 900,000 ounces were taken from HSBC vaults, and another 282,000 ounces were removed from JP Morgan. At the same time, 2.5 million ounces were adjusted into Loomis registered inventory, showing internal stress across the system. After these moves, total COMEX silver inventory dropped to around 400 million ounces, marking one of the largest single-day drains seen in years. This kind of physical metal exit does not happen quietly, and it does not happen without reason, especially when demand for real silver is rising. Here is where the contradiction appears, and it is something every viewer should pay attention to very carefully. While 3 million ounces were leaving COMEX vaults, more than 600 silver futures contracts issued delivery notices in just the first 4 days of February. Every single one of those contracts was accepted for physical delivery, pushing total deliveries to over 3,500 contracts in only 4 days. That equals roughly 17.5 million ounces of silver being demanded physically, not settled on paper. Under normal conditions, only 1 to 3% of futures contracts settle with physical metal, but right now that number is effectively 100%. This is happening because real-world industries cannot function with paper promises instead of actual silver. You cannot build advanced technology centers, power grids, or defense systems with contracts and digital claims alone. The global economy needs real metal, and that demand is growing faster than paper markets can hide. Now compare that physical tightness with what happened overnight on the Shanghai Futures Exchange, and the picture becomes even more extreme. In a single morning session, 1.4 million contracts were traded on the April 2026 silver futures alone. That amount of trading represents roughly 674 million ounces of paper silver changing hands in just hours. Across all silver contracts that morning, nearly 1.34 billion ounces were traded, which is almost double the world's annual silver mine production. This was not retail panic, and it was not everyday speculation, because no regular market participant moves that kind of volume that fast. What occurred was a deliberate and aggressive short-selling assault designed to smash prices and force liquidations inside the Chinese market. Yet, even after that historic paper attack, something important did not break. Silver prices in China remained at a strong premium compared to COMEX and LBMA markets, refusing to fully collapse. Silver also remained in backwardation, which is a signal that physical metal is more valuable than future promises. The paper games may shake prices temporarily, but they are not changing the underlying supply reality at all. As prices fell, unusual stress signals began flashing that even experienced risk managers admitted they had rarely seen before. Spot silver dropped nearly $9, while London spot pricing moved into backwardation against COMEX. The exchange for physical market started signaling tightness in London, even as leverage was being unwound elsewhere. These regional price gaps are not random, and they are screaming that something deeper is happening under the surface. London is currently showing the strongest bids, while China and the United States are aggressively selling futures to reduce leverage. That tells us this is a global deleveraging cycle, where paper positions are being dumped while physical silver is quietly being absorbed. Metal leaving the United States and China appears largely tied to speculative selling, while flows into London suggest real demand. That imbalance helps explain why spreads are behaving in ways that confuse traders relying only on charts. This does not mean prices will bounce immediately, and it is important to be clear about that reality. What it does mean is that the financial system built on leverage is showing signs of serious strain. The deeper issue appears to be a breakdown in a highly financialized market structure that no longer reflects real supply and demand. Instead of free market price discovery, we are seeing visible government action, regional controls, taxes, and intervention shaping outcomes. These forces are no longer theoretical, because policy changes are happening in real time across global exchanges. Now, this is where the situation becomes even more intense, because the response from exchanges and governments shows just how much pressure the system is under right now. The Shanghai Futures Exchange did not ignore what happened overnight, and within hours they announced new rule changes that directly impact silver trading. Starting Monday, margin requirements for precious metals are being raised across the board, signaling that volatility is no longer being tolerated at current levels. Daily price limits for silver futures were adjusted to plus or minus 20%, which is a massive move by any historical standard. Hedging positions now require margin levels as high as 21%, while general positions face margins reaching up to 22%. These are not small tweaks meant to calm markets, because they are aggressive actions designed to slow speculation and prevent further chaos. When exchanges raise margins this quickly, it means they are worried about systemic risk, not just price swings. In simple terms, it becomes far more expensive to hold leveraged positions, especially short positions that bet on prices falling. Now imagine this scenario, because this is where policy decisions start to trap traders. Picture being short silver at $70, confident that prices will keep falling as paper selling increases. Then suddenly, a government or exchange steps in and sets a price floor at $80. At that moment, your position is instantly underwater, not because of market movement, but because of policy enforcement. There is no pullback, no dip, and no second chance to exit at a better price. Trading below $80 is no longer allowed, which means losses are locked in by rule, not by market behavior. That $10 loss per ounce translates into $50,000 per COMEX contract almost instantly. At the same time, margins are raised, liquidity dries up, and forced liquidations begin spreading through the system. This is not a traditional short squeeze driven by buying pressure alone, but something far more dangerous for paper traders. If physical silver is tight and delivery is demanded, a paper short position turns into a physical obligation. If the metal is not available, traders must either pay any price demanded or settle in cash with penalties attached. This is why a price floor does not protect short sellers at all, because it effectively wipes them out. You can short paper silver, but you cannot short a government-backed floor once it is in place. The moment a floor is enforced, the old silver market structure stops functioning the way it used to. Could a floor be set below $80 instead, such as $75 or $70? Yes, that is possible, but doing so creates a different kind of problem. If the floor is set too low, miners slow production, refiners pull back, and physical supply begins to disappear. When that happens, the state is forced to either quietly raise the floor, buy metal directly, or subsidize the gap. In other words, a low floor does not solve the problem. It simply delays the inevitable adjustment. The true floor is not a number printed on a screen, but the price at which silver refuses to sell. While this is unfolding, Mainstream financial media continues mocking silver investors for volatility. Anchors point out that silver once traded above $120 and now sits near $79. What they fail to mention is that silver investors are still up roughly 150% over the past year. At the same time, Bitcoin is down about 26% over the same period and remains well below its highs. Yet, that asset is rarely mocked with the same tone or intensity, which shows clear narrative bias. As Alex Carter reports, balance matters, so it is important to address the bearish factors honestly. This deleveraging cycle is real, and speculative positions are being flushed out at a rapid pace. Margin calls are forcing weak hands to exit positions they never should have entered without a plan. Even experienced traders are struggling because the signals coming from markets are conflicting and unfamiliar. This confusion exists because events are unfolding in stages rather than all at once. Clear direction will only emerge once deleveraging finishes and the dust finally settles. From a technical standpoint, there are downside risks that cannot be ignored. If silver closes below the 73 to 74 zone on a daily basis, further downside becomes possible. A move toward $70 or even slightly below is realistic in the short term if selling pressure continues. This is not a prediction, but a technical scenario that traders need to respect. However, and this is critical to understand, none of this changes the structural deficit in physical silver. None of this changes the fact that 100% of COMEX contracts are currently settling physically. None of this changes the reality of 3 million ounces leaving COMEX in a single day. None of this changes Shanghai maintaining a $10 premium even after a historic paper crash. None of this changes that the LBMA benchmark snapshot has already been taken. Chinese short positions are likely trapped, and many cannot exit without significant losses. JP Morgan likely closed billions of dollars in short exposure near the bottom of the move. At the same time, demand for physical metal continues accelerating around the world. The state of Wyoming recently began buying physical gold and selected a private vault instead of JP Morgan. That is not speculation or rumor, but an official decision that signals shifting trust. Institutions are waking up to the reality that the traditional 60% stocks and 40% bonds model is failing. U.S. 10-year bonds are down roughly 50% since 2020. Gold, during that same period, has tripled in value. Despite that performance, gold currently represents only about 1.4% of typical U.S. portfolios. Imagine what happens to gold prices if even a small portion of bond allocations shift toward hard assets. Silver historically moves with gold, but it also carries heavy industrial demand on top of monetary demand. UBS recently stated that both gold and silver could move significantly higher in 2026. Violent pullbacks like this during long-term bull markets often mark the start of the next upward phase. Institutional conviction has not collapsed, even if short-term traders have. Artificially low prices created by paper raids often increase physical demand instead of destroying it. Supply continues shrinking while real-world usage continues expanding. JP Morgan has already been fined nearly $1 billion for manipulating precious metals markets. They paid the fine and continued operating, which tells you how broken enforcement really is. Markets are rigged, and that is exactly why self-custody and physical ownership matter. In just 90 minutes, silver prices were crushed through coordinated selling. Anyone still heavily leveraged in silver futures or relying on paper ETFs needs to rethink their exposure. These instruments are designed to transfer wealth, not protect it. Forced liquidations always benefit the same players over and over again. JP Morgan, State Street, BlackRock, and the CME system continue using the same playbook. Paper silver and physical silver are no longer aligned, and they are moving in opposite directions. To really understand what is happening now, we need to strip away the complex language and look at the situation in simple human terms. In just 2 hours, paper traders pushed silver prices down more than 20%, while at the very same time physical silver was being removed from vaults every single day. That disconnect between paper selling and physical demand is the core problem facing the market right now. The strongest signal pointing to this breakdown is coming directly from COMEX settlement behavior. When contracts settle with metal instead of cash, it exposes how little real silver is available behind the paper promises. This is no longer a theory or future risk because the stress is happening in real time. Paper markets are still trying to control price, but physical markets are beginning to set the rules instead. To frame this clearly, this crash did not punish everyone equally. It specifically targeted traders who were overleveraged and unprepared. Anyone who chased the breakout near $90 without a clear plan was exposed immediately. Anyone trading based on excitement, headlines, or emotion instead of structure was forced out. This is how markets clean themselves during long-term bull cycles. The famous trader Jesse Livermore once wrote that markets exist to prove the maximum number of people wrong. This move did exactly that, shaking out late buyers and weak hands all at once. Those holding physical silver without leverage did not get margin calls. Those stacking metal quietly at lower prices are not panicking. The pain was concentrated among those who trusted paper leverage to do the work for them. The strong hands are accumulating, while the weak hands are being erased from the market entirely. This is not the end of silver's story, but a reset of who controls supply. Right now, Alex Carter Reports is watching 3 key signals very closely. The first is whether silver can hold the 73 to 74 level on a daily closing basis. If price breaks below that zone with strong follow-through, then $70 and lower become realistic short-term targets. If that happens, it will not be because fundamentals collapsed, but because deleveraging is still working through the system. The second signal is the Shanghai premium. If that premium widens, it confirms that physical demand in China remains stronger than paper selling pressure. If it narrows sharply, it would suggest temporary relief in the physical market. So far, the premium is holding, which is not a bearish sign. The third and most important signal is COMEX registered inventory. If inventory continues bleeding while delivery demand stays near 100%, the math becomes unavoidable. At that point, the squeeze is no longer theoretical or emotional. It becomes a simple supply equation with very few outcomes. This is why price alone can be misleading during these moments. The market is transitioning from paper-driven price discovery to physical-driven price discovery. That transition is never smooth, and it is rarely calm. It involves violent swings, forced exits, and sudden rule changes. How long this transition lasts is still unknown. How aggressive it becomes will depend on how fast physical supply disappears. Where the final floor settles has not been decided yet. What is clear is the direction of travel. Physical metal is becoming more valuable relative to paper claims. Confidence in traditional financial instruments is weakening. Governments are stepping in more often, not less. State intervention, margin hikes, and price controls are signs of stress, not stability. This is why relying solely on charts without understanding structure is dangerous. It is also why blind faith in ETFs and futures contracts can be costly. At Alex Carter Reports, the message has never changed. Protect your capital first. Do not chase hype or panic moves. Do not trust anyone promising easy gains or guaranteed outcomes. This channel will never ask for your money. There will never be paid signals, managed funds, or investment pitches here. Scammers often use recognizable names during volatile periods, so stay alert. Always verify sources before acting on information. If this breakdown helped you see the market more clearly, share it with someone who needs facts instead of noise. What we are watching now is a financial system adjusting in real time to real-world limits. Paper markets can stretch reality for a while, but they cannot replace physical supply forever. The tension between those two forces is still unresolved. Every forced liquidation, every delivery request, and every policy change adds pressure. At some point, price must reflect availability. Whether that adjustment comes slowly or violently is still being written. What matters most is staying logical, patient, and prepared. This is not a game of excitement, but a test of discipline. The silver market is revealing who planned ahead and who did not, and this process is far from finished. Now let's bring everything together and look at what this moment truly represents, because this is bigger than one crash or one trading session. What we are witnessing is a system under pressure, slowly being forced to confront reality after years of relying on leverage and paper promises. For a long time, price discovery in silver was driven mostly by futures contracts, algorithms, and financial leverage. That system worked only as long as physical delivery was rare and easily ignored. But the moment physical demand surged and contracts started settling with real metal, the cracks became impossible to hide. This is why what happened was not a failure of silver itself, but a failure of the structure built around it. Paper markets tried to push price down quickly to regain control. They succeeded in crushing price temporarily, but they failed to break demand. Physical silver continued leaving vaults even as futures collapsed. That tells you everything you need to know about where real value sits. Every major forced liquidation transferred wealth from over-leveraged traders to well-capitalized institutions and long-term holders. This outcome is not accidental, and it repeats in every major market stress event. Those who rely on leverage are always the first to be removed when rules change. Those who hold real assets without debt are rarely forced to sell. This cycle does not reward excitement or bravado. It rewards preparation, patience, and clear thinking. At Alex Carter Reports, the focus remains on understanding structure, not predicting exact prices. Markets can stay irrational longer than traders can stay solvent. That is why risk management matters more than being right. Right now, silver sits at the center of several powerful forces. Industrial demand continues to rise as technology and energy systems expand. Monetary demand increases as confidence in currencies and bonds weakens. Government involvement grows as volatility threatens stability. These forces do not cancel each other out. They stack on top of each other. This creates an environment where price swings become more extreme, not less. Short-term moves may look chaotic. Long-term direction becomes clearer with time. The recent crash removed excess leverage from the system. It punished emotional decision-making. It exposed weak risk controls. It also created opportunity for those prepared to act rationally. This does not guarantee immediate upside. Markets often move sideways or lower after major deleveraging events, but it does reset the playing field. It reduces speculative pressure. It strengthens the role of physical demand. This is why watching inventory, delivery behavior, and regional premiums matters more than watching headlines. Price alone does not tell the full story anymore. Structure does, policy does, flow does. The silver market is no longer just a trading vehicle. It is a stress test for the global financial system. Every margin hike, rule change, and delivery request reveals how tight conditions really are. The outcome will not be decided in 1 week or 1 month. This is a process, not a moment. As always, protect yourself from noise and manipulation. Avoid anyone pushing urgency or fear. Avoid anyone promising certainty. No one controls markets forever. Reality always reasserts itself eventually. If you choose to participate, do so with logic, not emotion. Understand your risk, know your time frame, respect volatility, stay flexible, and most importantly, stay informed from verified sources. The transition from paper-driven pricing to physical-driven pricing is already underway. How intense it becomes will depend on how long physical supply remains constrained. Where the final balance settles is still unknown, but the direction is clear. Real assets matter again, preparation matters again, discipline matters again. This moment will be studied in the future as a turning point, not because of one price crash, but because of what it revealed underneath. The system is changing in real time. Those paying attention now will understand it later. Those ignoring the signals will be forced to react when it is too late. Invest with logic, not hype. Stay grounded, stay patient. This is Alex Carter Reports, signing off.